Amphenol Corporation is one of the most consistently excellent businesses most investors have never seriously analyzed. It makes connectors, the physical interfaces that allow electronic signals to pass between components, boards, and systems. 70,000 product types, 40 industries, 70 countries, and a 25-year track record of compounding shareholder value through every economic cycle.
The connector business looks boring until you realize that every F-35 fighter jet, every NVIDIA AI server, every electric vehicle battery pack, and every submarine on the ocean floor depends on Amphenol's precision interconnects to function. Boring component? Extraordinary economics.
American Phenolic Corporation was founded in 1932 in Chicago to make radio frequency connectors for the early broadcast industry. The company spent decades as a supplier to the military and aerospace sectors before a 1987 leveraged buyout transformed it into an acquisitive connector specialist with a global manufacturing footprint.
The IPO in 1997 opened the capital markets that would fund the acquisition engine. Amphenol has acquired over 100 companies in the past 2 decades, each adding a niche connector technology, a customer relationship, or a geographic presence. The model is disciplined. Buy companies at reasonable multiples, keep the management teams in place, and plug them into Amphenol's global distribution network.
Adam Norwitt became CEO in 2009 at age 40 and is the architect of the modern Amphenol. Yale history degree, Harvard MBA, and then 12 years inside Amphenol, learning the connector business from sales through operations before taking the top job. He's the rare CEO who both executes the strategy and deeply understands the products.
The IT Datacom segment becoming the largest revenue category in 2024 is the defining strategic shift of the past 5 years. AI server buildouts at hyperscalers require 4 to 8 times more high-speed connectors per server than prior generation equipment. NVIDIA Blackwell GPU clusters need Amphenol's high-speed backplane connectors, and those servers are being deployed by the millions.
The defense and aerospace moat is a different kind of durable. Military connector qualifications take 12 to 36 months and require government certification at every step. Once an Amphenol connector is qualified for the F-35 or a Virginia-class submarine, it stays on that platform for the 30 to 50-year service life of the system, creating revenue streams that outlast multiple product cycles.
The automotive electrification thesis is the second concurrent growth driver. EVs require 8 to 10 times more high-voltage connectors than internal combustion vehicles. Battery management systems, charging infrastructure, power distribution, and thermal management all require connector families that Amphenol has been building for a decade.
FY 2024 revenue of $15.2 billion breaks into 6 end markets: IT Datacom at 31%, automotive at 24%, industrial at 18%, military and aerospace at 13%, broadband at 8%, and mobile devices at 6%. The diversification is the resilience. No single end market drives more than a third of revenue, which smooths cycle volatility significantly.
The financial profile is exactly what you want from a serial acquirer. 33.4% gross margins, 21.2% operating margins, and 16.3% free cash flow margins that fund both the acquisition engine and a growing dividend. 8 bolt-on acquisitions in 2024 alone, plus 9% organic growth. The compound effect over 25 years produced a 525% total return in the stock.
12 consecutive dividend increases from 38 cents in 2019 to 66 in 2024 reflects the confidence that comes from a business model that generates reliable free cash flow across semiconductor cycles, defense cycles, and automotive cycles simultaneously. The yield is modest at 0.9%, but the growth rate of the dividend mirrors the underlying business compounding.
On the competitive radar, Amphenol scores 92 on both product breadth and acquisition execution, the highest in its peer group. TE Connectivity is the closest competitor with slightly stronger EV automotive exposure, but less acquisition track record. Amphenol's margin consistency score of 88 reflects 20-plus years of operating margins in a tight band, regardless of macro conditions.
The global network is 130-plus manufacturing sites across 70-plus countries, producing 70,000-plus product types for 40-plus industries. That manufacturing footprint is both the scale advantage and the customer intimacy advantage. Regional manufacturing for regional customers with the procurement leverage of a $107 billion market cap company.
Amphenol has compounded shareholder value for 25 years by being the boring but indispensable component that holds every electronic system together. The connector is the one part that every device needs and no one replaces unless they have to, which means once Amphenol is qualified into a defense platform or an AI server, that revenue stream is locked in for the life of the system.
The AI data center thesis is the newest chapter. Building a Blackwell GPU cluster requires 4 to 8 times more high-speed interconnects per server than prior generation. And Amphenol's high-speed backplane connectors are designed into the reference architecture. So the AI infrastructure build-out is directly translating into Amphenol's fastest-growing segment. And the automotive EV transition is the second tailwind running simultaneously. Amphenol Corporation reported Q1 2026 revenue of $4.8 billion, up 48.7% year-over-year, beating the $4.44 billion estimate by 8.1%. Adjusted EPS of 63 cents beat the 54-cent estimate by 16.7%. The IT Datacom segment, AI data center interconnects, grew 81% organically. Management raised full-year guidance. The stock rose 4 to 8% after hours.
Amphenol Corporation was founded in 1932 and is headquartered in Wallingford, Connecticut. The company designs and manufactures electrical, electronic, and fiber optic connectors, the physical interfaces that allow electrical signals to pass between components inside every electronic device. Connectors are inside smartphones, jet fighters, electric vehicles, MRI machines, satellites, and AI server racks. Amphenol serves 8 end markets: IT Datacom, automotive, military, industrial, communications infrastructure, broadband, mobile devices, and mobile networks.
At $118 billion in market cap, Amphenol trades at 33.5 times forward earnings. CEO R. Adam Norwitt has led the company since 2009 and has driven an acquisition-focused growth strategy, completing over 50 acquisitions since taking over. Amphenol has increased its dividend for 12 consecutive years and yields approximately 0.8%. The company targets consistent double-digit EPS growth through organic growth and acquisitions.
Q1 2026 revenue of $4.8 billion beat the $4.44 billion estimate, an 8.1% outperformance. Revenue grew 48.7% year-over-year, the fastest organic growth in over a decade. Adjusted EPS of 63 cents beat the 54-cent estimate by 16.7%. Adjusted operating margin reached 22.4%, expanding 110 basis points year-over-year to record territory.
The IT Datacom segment drove the beat. At $1.92 billion, 40% of total revenue, IT Datacom grew 81% organically. AI hyperscaler customers are building out GPU clusters at an unprecedented pace, and every server rack requires Amphenol's high-speed copper and fiber interconnects. NVIDIA's Blackwell GPU systems require significantly more connector density than prior architectures.
Automotive was the second growth driver at $820 million, growing approximately 20% year-over-year as EV adoption accelerated. Electric vehicles require 3 to 4 times more connectors than internal combustion vehicles, a structural content gain. Military grew approximately 25%, driven by defense electronics and acceleration. Diversification across 8 end markets creates resilience. Even if IT Datacom normalizes, automotive and military provide a growth floor.
Unlike software companies, Amphenol earns revenue through product sales and supply agreements, not recurring services. Gross margin was 33.8% in Q1 2026, reflecting the manufacturing-intensive nature of the connector business. Operating cash flow in Q1 2026 was approximately $780 million.
Free cash flow on a trailing 12-month basis was $2.8 billion. Amphenol returned $300 million in buybacks in Q1 2026. Management raised full-year 2026 guidance to approximately $18.8 to $19.2 billion, implying 30+% revenue growth for the full year. Q2 2026 guidance was 4.8 to 4.9 billion, with EPS of 62 to 64 cents.
The magnitude of the beat was the story. An 8% revenue beat at near 50 billion in annualized revenue implies management's visibility into AI hyperscaler demand is translating into actual orders ahead of plan. The guidance raise, not just a beat, validates that Q1 was not a one-time pull forward but the start of a sustained acceleration.
R. Adam Norwitt became Amphenol's CEO in 2009 at age 36 and has since overseen the company's transformation from a diversified connector manufacturer into a technology-intensive connector platform. Norwitt built the acquisition engine that added over 50 companies, growing revenue from $4 billion to nearly $20 billion. His background is in business development, and he has maintained Amphenol's decentralized operating model, where acquired companies retain their management and culture.
Analyst consensus heading into Q1 2026 was approximately 20 buy ratings, 5 holds, and 0 sells. The average price target was $90, representing 15% upside from the pre-earnings price of $78.50. After the beat, multiple analysts raised targets above $100, viewing the AI data center interconnect opportunity as structurally underestimated.
The bull case on the street centers on AI infrastructure duration. Hyperscalers, Microsoft, Google, Amazon, and Meta, have committed to $300+ billion in aggregate 2026 capital expenditure, with AI data centers representing the largest category. Amphenol's connector content per AI server rack is 10 to 20 times higher than traditional servers. JP Morgan raised its target to $105, arguing the IT datacom growth rate has at least 6 to 8 quarters of runway.
Morgan Stanley maintained overweight with a $95 target, citing the 8 end market diversification as underappreciated. While IT datacom drives the beat, automotive and military growth provide a floor. Even if IT datacom decelerates to 40% growth, still exceptional, Amphenol's blended growth rate stays above 25%.
More cautious voices flag the valuation. At 33 times forward earnings, APH trades at a significant premium to connector peers, including TE Connectivity at 21 times and Molex at comparable multiples. The bear case: if AI capex spending plateaus or hyperscalers pause after the current build cycle, IT datacom could decelerate sharply, compressing the multiple from 33 to 25 times, a 25% stock decline.
Consensus takeaway: the quarter was exceptional. The guidance raise was the real signal. Amphenol is in the middle of a multi-year AI infrastructure supercycle that is growing faster than management guided 6 months ago. The risk is valuation. The opportunity is duration. At 33 times, investors are paying for continued hypergrowth.
The bull case is the AI infrastructure supercycle is in its early innings. Every AI data center is a connector-dense environment. Amphenol estimates its content per AI server rack is 10 to 20 times a traditional rack. As hyperscalers scale from tens of thousands to millions of AI GPUs, Amphenol's addressable market within IT datacom grows proportionally. The 81% organic growth in Q1 is the highest in a decade.
The portfolio diversification compounds the upside. Amphenol's strength is that IT datacom is not its only growth story. Military electronics spending is accelerating as defense budgets rise globally. EV adoption is increasing automotive connector content per vehicle structurally. Even in a scenario where AI data center spending plateaus, automotive and military growth could sustain 15+% blended revenue growth.
M&A optionality is real. Norwitt has completed over 50 acquisitions since 2009 with a consistent playbook: buy companies with 20% plus operating margins, integrate with a decentralized model, and grow revenue organically post-acquisition. Each acquisition expands Amphenol's technology portfolio and customer relationships. There are no signs the pipeline is slowing.
The bear case starts with valuation compression risk. At 33 times forward earnings, APH is priced for sustained hypergrowth. Connector companies historically trade at 15 to 20 times forward earnings in normal growth environments. If IT datacom decelerates from 80% to 20%, still above average, and the multiple compresses to 25 times, the stock would trade near $60, representing a 25% decline.
AI CapEx concentration is the binary risk. IT Datacom is now 40% of revenue and growing at 81%. A pause in hyperscaler AI spending, triggered by AI ROI concerns, NVIDIA supply constraints, or a macro downturn, would hit Amphenol disproportionately. The CIT acquisition in 2024 added significant IT Datacom exposure just before the cycle peaked in prior years.
Competitive dynamics are evolving. TE Connectivity, Molex, and Asian manufacturers including Luxshare and Foxconn Interconnect are all investing in AI connector capabilities. Amphenol's technology lead in high-speed interconnects is real today, but connector standards evolve. If the industry converges on a standard interconnect architecture that lowers switching costs, Amphenol's pricing power diminishes.
Execution risk from acquisitions compounds over time. 50-plus acquisitions create complexity. Integration missteps, cultural friction, or overpayment for a large target could impair returns. The M&A growth engine requires continuous deal flow. A tightening deal market or rising acquisition multiples would slow the model.
The connector peer comparison, APH versus TE Connectivity and Molex. TE Connectivity trades at 20.8 times forward earnings with revenue diversified across connectors, sensors, and transportation. TL's exposure to automotive and industrial markets is similar to APH's, but TEL lacks significant IT Datacom exposure, explaining the multiple gap. Amphenol's AI content justifies a meaningful premium.
Gentex Corporation trades at 22.4 times, a premium for an autotech-adjacent connector company with electrochromic mirror dominance. Rogers Corporation at 18.5 times reflects specialty materials exposure rather than pure connector competition. The comparison validates that premium connector multiples are achievable only when there is a defensible technology moat, which Amphenol has in AI interconnects.
Flex Limited at 14.2 times forward earnings illustrates the discount applied to contract electronics manufacturers without the technology moat. Amphenol's gross margin of 33.8% versus Flex's 12% demonstrates the value creation in proprietary connector technology versus contract manufacturing.
The peer takeaway. Amphenol's 33 times multiple is at the high end of the connector peer group, but it reflects a unique combination of AI data center exposure, automotive EV content gains, and military electronics acceleration that no single peer matches. The premium is justified as long as IT Datacom sustains above-market growth.
Pre-earnings options positioning was bullish. The put-call ratio was approximately 0.72, below the typical neutral range, reflecting call accumulation. The options market implied a 4 to 5% earnings move. The actual 8% after-hours gain exceeded the implied move, confirming the magnitude of the beat was larger than options traders modeled.
Post-earnings call activity was aggressive. Buyers accumulated the $80 and $85 strike calls for June expiry immediately after the print, betting on a continued move higher into earnings digestion. The thesis: Amphenol's gains after strong beats historically hold and extend into the subsequent 2 weeks as institutional rebalancing occurs.
CEO R. Adam Norwitt has maintained standard executive equity participation without significant open market selling. Amphenol returned $300 million in buybacks in Q1 2026, at prices around $75 to $78 pre-earnings. The buyback at those prices reflects management confidence in the intrinsic value above the pre-earnings level.
Amphenol's dividend history reinforces the capital commitment. The company has raised its dividend for 12 consecutive years, from 39 cents in FY 2020 to 63 cents in FY 2026, a compound annual growth rate of approximately 8%. Free cash flow of $2.8 billion covers the annual dividend by approximately 8 times, one of the safest dividend coverage ratios in industrials.
Amphenol delivered 49% revenue growth, 16% EPS beat, IT Datacom up 81% organically, guidance raised. The AI infrastructure supercycle is driving unprecedented demand for high-speed interconnects. The process is intact.
Risks are real. Valuation at 33 times IT Datacom concentration, AI CapEx cycle risk. At 33 times, APH is priced for sustained hypergrowth. Watch IT Datacom growth rate in Q2 and whether operating margin holds above 22%. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.